Hello, everyone. Welcome to today's webinar. I'm your host, Nugwa Haruna. How does making money while you sleep sound to you? Probably pretty appealing if you're like most people. That's why many investors gravitate towards dividend-paying companies and the passive income that they provide. Of course, it's not as simple as buying any old dividend stocks out there, kicking your feet up, and collecting checks. There's so many out there to choose from, and they can hold different opportunities as well as different kinds of risks. So then how do investors decide what kind of stocks to invest in? Well, longtime dividend investor Mike Heroux from Dividend Stocks Rock is here to share his approach. He uses a set of criteria called the Dividend Triangle to help him find dividend stocks he believes provide a significant upside. Let's bring him in to learn all about it. Welcome, Mike. Thanks for joining us.
Thank you so much for having me, Nugwa. I'm super excited to talk about dividend stocks today.
And we're super excited to have you. So you're an active blogger, and you're the founder of Dividend Stocks Rock, a community for dividend investors. But before that, you were a private banker with 13 years experience in the financial industry. What made you walk away from a well-paying and secure corporate job to become an entrepreneur?
Yeah, so I had a lot of fun working financial industry, and at one point, my wife was running a daycare from home, and she got fed up of like starting to work at 7 in the morning and then ending up their days around like 7 p.m. So we decided to take a sabbatical year and just travel across North America and then Central America with a small RV with 3 kids. And at the same time, I was running a blog, and then I started Dividend Stocks Rocks just more as a side gig than anything else. And as we were traveling, I just wanted to reach that kind of freedom. And instead of helping like 300, 350 people as a private banker with their investment and retirement planning, I realized I could help thousands of people. So when I came back in 2017, I decided to quit my job and work full-time on DSR, which brought it to like 175 members back then to about 3,000 today.
Wow. Oh, great. I love that story of taking a sabbatical and finding your calling, because that's essentially what happened to you. So,
Yeah, that was an eye-opening.
yes, I can imagine. So right now, though, your day-to-day is all about dividend investing. What's the big appeal of dividends to you?
When I started investing in 2003, I was more like not a day trader, but I was like buying and selling every week or every 2 weeks. I was just like riding momentum. It was during the good years as well, like between 2003 and 2008. So I was just like making money, doing leverage. I was having fun. And then I bought my first house. Fortunately for me, it was before 2008, so I didn't have to lose much money during that crash. But then what happened is towards those years, I was taking more and more risk, thinking that I could just like buy pretty much anything and I would turn it into gold, right? Because those were good years. And then I realized that investing in penny stocks is not necessarily a good thing. So I lost a lot of money, and I started to realize that I didn't have a well-defined investing strategy. It was like more about guts and feelings and doing a lot of study online. And what I decided to do after that is I was already like in the personal finance blog business. So I decided to buy a blog, which called the Dividend Guy blog. I started to interest myself into that part of investing. And then I realized that dividend growers and not just dividend payers tend to have robust balance sheet. They tend to grow their business. They have like leadership, great market shares, and all those great factors that makes a business perform well and create value for shareholders. So what's going to happen is when you buy a company that is able to increase its dividend year after year, most of them will perform well because they are able to increase that money. This means that they have a lot of cash coming in. And as any type of investors, this is what you want. You want to buy healthy business that will thrive in the future. And this is what I like about dividend growth investing. Plus, when the market goes down, you can always forget about your portfolio value that is down, but you can look at your dividend payment that is usually still stable and most of the time will continue to go higher during those bad times. So it's a good reminder that the market goes up, the market goes down, but if you stay invested, you don't have to worry about it too much, and great companies will always come around.
So I wanted to just pick out something you mentioned. So you were talking about, dividend investing, but you were focusing on dividend growth, right? So you consider yourself a dividend growth investor. Now, how does that approach differ? So how would you say your approach differs from, let's say, dividend investing in general, or an investor who wants to practice more of a buy and hold investing strategy?
Yeah, so first, it's kind of funny because sometimes I go with the nickname the dividend guy. And sometimes people are telling me, well, Mike, you're not really a dividend guy because your average portfolio yield is about 2%. So for a classic dividend investor, he's going to research for companies that will pay 4, 5, 6% yield because the goal is to generate enough income so you can retire. If you want to retire on a 2% yield, you need several millions, right? So it's going to be very difficult. So that's one difference is I don't really mind the yield. So I could buy a stock giving a 0.5 or a 1% yield as long as they show me that they can increase their dividend year after year. This is what really I'm after. So I use the dividend growth as a factor, a determining factor to tell me if the company is doing well or not versus someone that would just chase a yield. And most of the time, what is unfortunate is that if you chase high yield stocks, well, there's usually a reason why they will pay a 7% yield, why interest rate is super low. I mean, there's no free lunch in finance. There's obviously another risk there. And several of them, and not all of them, obviously, but several of them, when they hit a recession or they hit like major events that will shake up their business, they will eventually have to cut their dividend. And then you lose in value because most of the time it's obviously not a good news. So a lot of investors will sell their shares. So the stock price drop, your income drops, and then it's really hard to turn around and make something out of it. So this is why I rather go with dividend growers, at least 5, 10, 15 years sometimes. So they show me they've been able to go through recession and still be able to do their job and still having a good business and not going into too much debts or losing market shares and like basically going on the wrong side of the investment world. And for that reason, I think it's really important to focus on the dividend growth aspect, especially that over time, this is what I've experienced also with my portfolio. And obviously what happened in the past doesn't mean it's going to happen in the future, but so far so good. I've been able to beat most index or ETFs. And then when I compare myself to the market, almost every year I'm able to outperform the market, and over a long period of time, it pays very well.
Okay, so still on this topic of choosing, let's say, dividend growth stocks. So on average, you have a lot of investors who are starting off who may not have a significant or sizable portfolio. So when they start thinking about dividend investing, for them, those dividends might not amount to anything meaningful. So what would that approach be for investors in this kind of situation?
Well, if you start with like, let's say you start with like a few $1,000s and then you want to start your portfolio, obviously you're going to receive a few bucks every quarter, every year in dividends. So it's not going to make a big difference. If you generate like 50 bucks of dividend per year, you're not going to feel rich. You're not going to feel that you have this impression that you can retire on that, obviously. And this is probably like one of the downside of dividend growth investing. It's far from being sexy. This year we had like a lot of meme stocks, a lot of people that made like a lot of money on companies that goes up very fast or within the cryptocurrency world. And then some people would say, yeah, but I'm not able to double or triple or quadruple my money within a year, and especially not with those small dividend. But it's a long-term approach. You have to start young, and then in 10, 15, 20, 30 years, you're going to see it's like building a snowball. So there's that snowball effect that every single year you're getting more and more dividend. And then at one point, it's going to make a difference in your portfolio. But at first, obviously, it's not that tempting, but it's really the part where you have to be patient. And instead of focusing on the dollar amount, just look at how fast it grows from year to another.
The mistake that some other investors could have is they could suffer from over-analysis paralysis, right? So where they're having a hard time deciding what kind of stocks to choose because there's so much information out there. So you have simplified the selection process using the dividend triangle. So tell us a little bit about what that is and how it works.
Yeah, I think today there's nothing more incredible to have access of information through like YouTube, to podcasts, to like webinars like we're doing right now. And the internet is an amazing source of information. The problem is when you go into that rabbit hole, at one point you could spend like 20 hours a day researching for stocks, and after a full week you will still be researching and reading more like contradictory opinions telling you to buy, telling you to sell, and then you just get lost. So what I did is I tried to simplify my strategy to a maximum, and then I can dig a little bit further, but only for a few stocks. So what I've decided to do is I've looked at several metrics, combined them together, and then I created what I call the dividend triangle. There's no like studies behind it or anything, but that helps me in my process to keep it clear and straightforward. So I look at three metrics at first, which are like trends over 5 years. So it's not necessarily the number that is important, but more how the trend reacted over the past 5 years. So the first metric I look is revenue. I look at revenue trend because I want a company that has great market share, that is a leader in their market, that has any kind of like growth vectors. It could be innovation, R&Ds, mergers or acquisitions. So if they buy new businesses all the time, they develop an expertise, and then they're able to integrate them in their business and make more sales. So this tells me, oh, this company keeps growing, and I'm more type of like offense is the best defense type of investor. So I'm thinking if a company keeps increasing its revenue all the time, whenever they will reach they will hit a recession, it's not going to be that bad because they're already moving forward. So they're not a mature business trying to just maintain their business as is, getting eaten up by competitors. They are actually eating up competition. So that's the first metric. The second metric is earnings per share. In an ideal world, I would actually track cash flow, but the thing with cash flow, it's like the money in your bank account. It goes up, it goes down every single day. So it's still a bit more hectic, and then earnings per share is a little bit more smoother in terms of numbers you can follow. And over 5 years, it's very hard to hide something or to make it look very good in terms of accounting rules. So at one point in time, you'll see if the earnings are going up or going down. What the earnings per share will tell me is, does the company makes profit first? Because it's one thing to sell, to make big sales, but if you're not making money out of it, you're not necessarily going towards the right direction. I mean, obviously, small startups will lose money and it makes sense, but this is not what I'm after. So I'm looking for a company that is making money more and more. So good pricing power, probably healthy margin, and eventually a robust balance sheet. So once I have a company that is growing in terms of sales and that is actually making profit, the third metric that we'll look is obviously the dividend growth. So I will look at the trend of the dividend. So if you just look at the 5 years number, the problem is maybe a company has increased it 4 years ago by like 25% and then nothing after, and we'll still show like an average of like 4% dividend increase over the past 5 years. So it's kind of like not telling you the full story. So what I want to see is the company is able to consistently increase it year after year. So it's more important for me to see, let's say, a 5% increase every year than having a business that increases its dividend by 15% and then nothing for 2 years and then another 8% or cut it eventually. So I want to see consistency. What it tells me is, as I mentioned before, management is confident in their business. They know that because, for a business, for a company, paying a dividend, it's like paying another debt. It's just like increasing their burden of financial obligation. So if they have to pay $1 of dividend every single year, and the year after they say, oh, we're going to pay $1.05 and then $1.10, it's because they're confident that their business will do well in the future. If not, they're going to keep it at $1 and hope that they can still afford that extra payment. So it's a sign of confidence, it's a sign of trust in the business, and it's also a sign that the business should do well in the future. And this is how I start all my stock screener, my research, trying to have companies that shows positive numbers, pretty much close to each of them. So maybe like 5-6% would be ideal. Sometimes it's higher, sometimes it's lower. You have to adjust a little bit from different types of industries. But this is my starting point. After that, there's a bunch of metrics. There's like more there's more revision to be made. But if the company doesn't fit the first criteria of showing revenue growth, earnings growth, and dividend growth, this is my signal. This is my red flag. Even if I see like at one point, if the trends start to slow down once I have it in my portfolio, I'm going to dig a little bit deeper and I might eventually sell that stock. So I really put a lot of emphasis on those three metrics.
All right. So to recap, what makes up the triangle is we have the revenue growth, the earnings per share growth, and this is over a 5-year period, and then the dividend growth. And with the dividend growth, you're looking for consistency, which would be year after year.
Yeah,
Right?
that's
Okay.
correct.
All right. Okay, awesome. So as an investor, how would you break down, the sectors to invest in as you decide to apply those matrix that we talked about? And then what weighting would you give to each of these sectors?
What I'm trying to have in my portfolio is I want a portfolio that is invested in several different sectors. One of the reasons why I do that is I don't know the future. You don't know the future. And at one point, each crisis on the market will affect sectors differently. So if you've mostly invested in in technology stocks during the tech bubble, well, you got hit hard and it took a very long time before you got your money back, as opposed to another investor that would have been equally invested in several sectors. Of course, his portfolio will go down, but because he doesn't have all the companies that eventually went bankrupt because that was all about that tech bubble, then it will be easier for them to recover. So in general, I try to not go over 20% per sector in terms of weighting. And then it really depends on what you want to achieve with your portfolio. So if you are an income investor, so maybe you're retired and you want to generate a maximum yield out of your portfolio, well, you can do it if you go for sectors like utilities or real estate or telecoms that are known to be a little bit more stable and a little bit more generous with their yield, as opposed to an investor like myself who focuses a little bit more on total return. So I'll have a little bit more technology stocks, a little bit more of consumer discretionary, because when the economy goes well, people have more money in their pocket, so they spend more. So those are like companies that will do well. Industrials, some financial as well. So it will really depends on how you want to manage. And one thing that I find super important, there's 11 sectors. You don't need to know and master the 11 sectors and invest in all of them to have a great portfolio. If you have like 6, 7, 8, 9 sectors in your portfolio, you'll be able to go through any kind of recession and will be less affected than if you just focus on one. I know many Canadians love Canadian banks and they have like the tendency of investing like a lot in just a specific industry because they say, yeah, they look back and they say, well, they always perform well, so it should be a good thing. Let's put 50% of our money in there. Well, we don't know if we're going to have at one point maybe a housing bubble or like a mortgage crashes, and then all their financial, as it happened in the US in 2008, and then you will see maybe like a bunch of bankruptcies. Well, you don't want to have 50% of your portfolio invested in a single sector for that reason.
So that's where that saying of "don't put all your eggs in one basket" comes in. And I know
Yeah.
that, yeah, and I know that here at TD Direct Investing, we actually offer master classes on portfolio management. We have a lot of other webinars on portfolio management because we talk about that. We talk about diversification and asset allocation, right? Where by doing that, you're minimizing your risk while maximizing your return within that risk level that you're taking. So that's a great point to bring up because investors still want to think about that, right? Instead of focusing on one sector, consider multiple sectors because that way you'll be able to do some asset allocation and diversification. Okay, Mike, how would you group the various sectors together in terms of what they might offer a dividend investor's portfolio?
So I have a very personal way to do that. The first thing is I have like what I would consider the core sector. And core sector in a sense that I think most investors should have at least some of those companies in their portfolio. So we have technology. A lot of people will tell me, yeah, Mike, but tech stocks are usually growth. But what I really like about the dividend payers is that they're older companies. They have a lot of cash flow. And for that reason, I think they are very well suited to go through any kind of recession, especially that right now with Internet of Things, with artificial intelligence, all the component that we put into cars, into industrials. So I really think that technology should be part of the core sectors. And then we have financial services. Obviously, financial services, we're in the middle of the capitalist system. We need them to function. We need banks, we need life insurance companies, we need assets managers. So this is why they are part of core business. And we all know how Canadian banks pays great yield, and most of them are paying dividends. So it's easy to pick some of them there. You also have consumer defensive or consumer staples companies. As I mentioned earlier, they're very stable. People need to eat, recession or not. So those companies will do well throughout time. So they will be a little bit more kind of like a foundation in your portfolio. And then you have healthcare. Regardless of what happens, pretty much similar to people need food. Well, we need our medicine at the same time. So those will be like the core sector. Then we move on to growth. So companies that will likely give you a little bit more total return and a little bit less yield. That will be consumer cyclicals, or often called consumer discretionary. And the other one is industrial. Industrial because they're highly cyclical. So it means that they will go up and they will go down and they will go up and they will go down. So whenever you're able to catch them on a down cycle, well, chances are that you're going to make a lot more money moving forward. So they will give you a little bit more growth. You also have the income sector that we're called. I talked about it a little bit. So real estate, REITs. Utilities, because they're super stable. We need our power, we need our gas, we need our water. And then telecoms, pretty much the same thing, especially in Canada, because we work in an oligopoly. So few players, they all have their market shares and it's doing pretty well for everybody. And we kind of like paying high fees for those, right? So it's good for income. There are two sectors I don't like for dividend growers. They are basic materials and energy, mostly because most of their businesses, they will have a business model that will revolve around a commodity price. And then oil, gas, gold, copper, lumber, it goes up, down all the time. So it makes it very hard for a company to manage consistent cash flow because it's a bit hectic. So most of the time they will not be able to maintain a dividend and increase it year after year. So they'll have like huge increases. And then if there's a bust in their industry, it's going to go down again. They will be forced to cut their dividend. And super important, I'm trying to avoid dividend cutters. And I found that there's a lot of them in the energy and basic material sectors.
All right. So to recap the groupings, you would have the core, the growth, and the income.
That's
Right.
correct.
All right. Okay. Okay. So let's tie this all together. And let's say you have a handful of stocks that actually meet the dividend triangle criteria. How do you decide which to add? Because yes, we've talked about different sectors. There's a potential you could find within those sectors several companies that will fit within some of the criteria we talked about. So how do you decide which to add to your portfolio and how much?
I will narrow it down to see what my portfolio looks like at this point. So at first, I'm going to prioritize sectors that I'm a little bit underweight, for example. So if I have like only 5% in a specific sector, I will prioritize those. Then the second thing I will do is I will also try to get the best company for each sector. So if after running my screener, I get and say, oh, okay, so I'm going to buy my fifth or sixth company in the same industry, well, that doesn't make sense. And this is usually what's going to happen when you run like stock filters, regardless of the metrics that you're going to use. From time to time, a sector will show will have like a lot of tailwinds and they will do well. So most companies in that sector will actually show great metrics. But buying 5, 6, 7 stocks from the same sector is not going to help you out. So I will look at the sector allocation and then I will try to keep the one that are like the best one for each industry. And finally, the most important part is I'm going to write down my investment thesis for every single stock I have. So the investment thesis is basically all the reason why you think this company belongs to your portfolio. I mean, we work super hard for our money. We have to make sacrifices to save some aside and then invest it. It's not true that the thousands of stocks on the market deserve your money. Only a few of them will. And if you're able to write down the reason why you buy this company, and then you have like 10 reasons, well, it's probably a good choice for you.
All right. So you mentioned using filters to find these companies and then making these decisions. And so investors are able to do this using a screener tool, like you talked about. This will help simplify how you're able to sort and find these companies. So what we're going to do is we're going to head into WebBroker, because in WebBroker, I will be able to show you the screener tool. This will help simplify your stock selection process. So we'll head to the question and answer, but we'll head there after we step into WebBroker. I'll show you how to use the dividend triangle criteria in there, and then we'll come back. Once in WebBroker, click on Research. Under Tools, click on Screeners. The Screeners tool allows you to filter different investments by criteria that are important to you. In this case, we're going to create a new stock screener. To do so, click Add New. Once here, we have the chance to choose an exchange. So for this example, we're going to choose any Canadian exchange. Scroll down. And now let's go ahead and create our dividend triangle. The first criteria we're going to select is dividends. Under dividends, we will select dividend growth rate current to prior year. We're going to add this criteria. Next, under growth and earnings, we will select earnings per share growth last quarter versus prior year, and we will add this criteria. Finally, still under growth and earnings, we will select revenue growth last quarter versus prior year and add this final criteria. Scrolling up, we have an opportunity to choose the minimum growth rate we want to see as well as the maximum growth rate we want to see. Let's select a 5% minimum growth rate for each of our criteria. Once that is done, we now have 35 stocks that meet our criteria. To view these 35 stocks that trade on a Canadian exchange, we will scroll down. Once here, click Detailed Results. And this will give you a full list of the 35 stocks that meet your criteria. If you would like to export this list into an Excel file, simply scroll down and click on Export. Finally, you have the option of saving this screener to view at a later time. All you need to do is click Save Screen, and you'll have an option of coming back to see what stocks meet your criteria at any given time. Okay, so before we head off to the question and answer segment, how about you let all our viewers know where they're able to find more information about you online?
Yeah, of course. Well, first, dividendstocksrocks.com. Obviously, if you go there, it's my membership website, but I also offer a free ebook that is actually tackling a lot of topics that we have discussed today. So it's going to help you work a little bit more on your investing strategy and understand a little bit more about how it works, and completely free. So you head on to dividendstocksrocks.com, download the ebook. And if not, I have a lot of free content, because if you look at the Dividend Guy blog, I have a podcast and also have a YouTube channel. So regardless on if you prefer to read, listen, or to watch, I'm pretty much everywhere.
Okay, thank you so much, Mike. And now we're going to head over to a question and answer segment.